Hello, everyone. My name is Kevin Croft. I am the EMC Associate Professor of Practice and Director of the Kelly Center of Insurance Innovation at Drake University. It is my pleasure to now introduce the Dean of the College of Business and Public Administration, Alejandro Hernandez.
Hello, everyone. This is Alejandro Hernandez. Good morning, good afternoon, good evening, and welcome to Drake University. On behalf of the students, the faculty, and the staff here at Drake, I'd like to welcome you to our Risk and Opportunity Forum. We have an incredibly robust number of registered attendees. Joining us today, we anticipate more than 250 academics and practitioners from 10 countries across 4 continents. Clearly, the topic of risk and opportunity has struck a chord with many of us. Our university's location here in Des Moines, Iowa, a city which is home to more than 80 insurance companies and a number of global financial services firms, puts us in a unique position to host a day of conversations on the impact of risk on strategic decision-making and how those choices make impact on individuals, communities, and countries. It's clear that the risk landscape is changing fast. All you need to do is look at your news feed to see stories that proclaim that an uncertain future is on the way. And sometimes it feels like new risks and response strategies are around every corner. As I remind our students often, we're operating in an ever more globally complex, diverse, and dynamic world. It's clear that the future is going to present more new opportunities and a unique set of challenges. I think this raises a number of questions for academics and practitioners. Questions such as, have we learned anything substantial about risk from the pandemic and its aftermath that we can put to work in the future? I mean, clearly, cybersecurity is a concern, and I'm very interested in seeking answers to the questions about what kind of preparations are needed for a future where cybersecurity is going to be a paramount concern if it isn't already. There are other questions about how organizations are using technology to assess risk, and what are the risks of bias in those approaches? Those are very challenging questions. And there are also questions that organizations are considering as they manage their response to social issues as part of their ESG or sustainable investment strategies. And clearly there are a number of emerging issues that we'll have an opportunity to examine today that are potentially going to create the greatest challenges in the future, even though they're only emerging today. These complex questions are challenging, but the good news is that the strategic conversation around risk is changing. I see enlightened leaders recognizing that risk can be used as a tool to create value, to achieve higher levels of performance, and to deliver on their organization's higher purpose. And I say that because I think that as leaders, mentors, educators, learners, we shouldn't miss the chance to push even harder for greater innovation and more inclusive strategies. And what's great is we have that chance, at least today, to delight in what is possible. Thank you for being part of this Risk and Opportunity Forum. You represent nearly 100 public and private corporations and institutions, and I believe we all have a stake in harnessing our collective energy to be even stronger and more resilient as we emerge from a very challenging era. And I think we emerge with a heightened sense of appreciation for each other and society as a whole. It's my hope that together we will lift up the learnings and best practices from across sectors today to benefit all of us and the people and communities we serve. Again, welcome to Drake. Look forward to a great day.
Thank you, Alejandro. Appreciate your thoughts. We will take one moment and promote our panelists and get underway shortly.
Good morning. Tom, are you out there? There he is.
Yes.
All right. Commissioner, Senior Director, I'll get to introduce you. So I'm going to go ahead. Good morning, everyone. I'm Nick Gerhardt. It's my privilege and honor to introduce Tom Sullivan as our kickoff speaker this morning. I've known Tom for many years when he served as insurance commissioner to the great state of Connecticut. And, he has a historic career in the industry. Before that, after his tenure as commissioner in Connecticut, he went on to do some consulting before the Federal Reserve made one of their smarter choices of bringing an insurance expert like Tom. And he's now the senior associate director at the Federal Reserve Board of Governors overseeing insurance, and I believe also other financial services, right, Tom? So he's got a breadth of experience in risk and regulation and the committee. We thought he would be just a great speaker to kick us off this morning. So Tom's going to make a few remarks, and then I'm going to ask him a few questions. And if we have other questions, Kevin's going to probably gather them in the chat, or I will. So Tom, without further ado, we're looking forward to your remarks, and good to see you, buddy.
Sure. How's the audio, Nick?
I can hear you perfect.
Perfect. Well, good morning, ladies and gentlemen. It's a pleasure to join you at the Risk and Opportunity Forum. We're holding the conference virtually, which we're all apparently getting used to, though we look for a brighter day when we can all gather together. Having this conference virtually, though, is relevant, as I intend to dive deeper into the topic of operational resilience. But before I begin my remarks, let me first wish all of you and your families good health. Let me thank the Drake University College of Business and Public Administration for organizing this timely and important event. So I do appreciate the gracious invitation. We are indeed living through some difficult times. Consider for a moment the pressing issues of the day and the challenges that stand before us. Examples such as global conflicts, social and political unrest, climate change, cyber attacks, and of course, the COVID-19 pandemic. COVID-19 appears to be increasingly under control. However, in some parts of the world, it is unfortunately not under control. Our collective well-being still has a long way to go, and how the public and private sector respond together to risks like the ones we are confronting can be illuminating, and we can learn from these. There was an unprecedented size and scale of fiscal and monetary stimulus given during the beginning of this pandemic. It was indeed commensurate with the challenges the pandemic posed to the financial system. While the long-term effects of the crisis are yet to be fully understood, the results of the measures taken in response to COVID-19 seem to be positive. Of course, this will be more fully judged once we emerge and return to life as we knew it. But the public and private sector has laid the foundation of resilience to absorb the pandemic's shock in the aftermath of the financial crisis over a decade ago. So we learned much from that experience. First, the public sector learned much from the crisis in terms of response mechanisms and how to infuse liquidity into the system, such as in a time of stress. Next, the private sector has also become much more mature in managing risk. This discipline has enabled banks and other regulated financial entities to enter the current crisis significantly better capitalized and more liquid than ever before. It's allowed them to weather losses while continuing to lend and execute financial transactions. So it's indeed this rigor that has improved financial resilience of the system. In the post-financial crisis era, we observe that there is better governance, risk and controls, better ERM, enterprise risk management. We've introduced techniques such as stress testing, recovery and resolution planning, and other disciplines into financial firms. Some of these things are no longer just best practices, but are table stakes for large financial firms in order to take a more holistic, risk-focused introspection and be able to respond to incidents. Yet, despite a safer system that is more resilient to certain vulnerabilities, efforts to safeguard against large-scale shocks from operational failures or significant operational disruptions may not be as mature. During the COVID-19 pandemic, the financial system has demonstrated its resilience, but it has opened our eyes to a vast array of operational risks that can test resilience. The pandemic has posed challenges to everyday life. There's no doubt about that. Some of these unimaginable. The recently increased number of significant disruptions from cyber attacks, as one example, and other technological disruptions have brought additional risks to the forefront of our concerns. Natural disasters have highlighted the threats to operational resilience as well. So all of these hazards, though different in nature, have a single common attribute. They are all a growing part of the overall risk landscape within which the financial system operates. As we've seen with many headlines this year, the cyber threat landscape continues to affect the entire financial sector. There were multiple high-profile events this year, including the SolarWinds event or the Microsoft Exchange incident. Each of these and others have had significant impacts. Within cyber risk, one of the more impactful threats to the sector has been ransomware. It has been a high-profile year for ransomware attacks, as there have been incidents that have made headlines across all sectors. These threats have the potential to reach out much further and in much more significant ways. The theft of customer data is no longer a concern for one branch or one institution, but rather the cascading effects could be felt worldwide. It is therefore more important than ever to think of an operationally resilient financial system that is resilient to a full range of operational risks. It's not a question of if, but a question of when large-scale shocks from operational failures induce significant disruptions that will test the financial system's hard-won financial resilience gains. So it's to that end that many of these risk stripes can't be merely cured with add-on capital requirements or enhanced liquidity, some of our so-called go-to regulatory response tools in our toolkit. But rather, because the global economy is so interconnected, it is more complex than ever, facing more shared challenges. We need to rely on the international regulatory community and others so that we can get the kind of guidance that the Financial Stability Board offers us, the Basel Committee on Banking Supervision, the International Association of Insurance Supervisors, the IAIS, and IOSCO, the International Organization of Securities Commissions. They have all come together to form partnership to solve some of these shared challenges for us in the regulatory community. The FSB, through its committee structure, continues to monitor and promote standards focused on macroeconomic issues. And earlier this year, the Basel Committee issued two sets of principles, one for operational resilience and the other for the sound management of operational risk. The Basel Committee has stated operational resilience is an outcome of effective operational risk management. So these two sets of principles were issued in tandem. And we at the Fed continue to work in close collaboration with the other federal banking agencies, other governmental agencies, these international bodies, all to bolster the financial resilience of the financial sector. Our efforts may not prevent a large-scale operational risk from materializing, but a pragmatic, well-constructed, and harmonized approach to operational resilience can help minimize any impact and enhance the financial system's ability to withstand a severe shock. Firms are now predominantly more susceptible to a wide array of potentially serious disruptions, which could be cyber-induced. The contributing factor of these disruptions are the speed of technological change, a growing resilience on third-party based service providers. Couple all that with an increasingly systemic and complex interconnected financial ecosystem. So the financial sector firms have done very well overall and continue to deliver on critical operations successfully through the prolonged period of disruption that the pandemic presented. But limited global convergence on operational resilience in a post-COVID era has the potential to undermine these efforts. So let's talk about potential solutions for the challenges we all face. Achieving operational resilience is not easy and can't be done in the short term. It requires our firms to invest in people, process, and technology, which of course introduces cost into the equation. I would like to enumerate some solutions to strengthen the operational resiliency of individual firms and the financial system as a whole. First, an optimal solution is to adopt considerations for operational resilience, such as what was contained in a Fed-issued piece of guidance known as Fed SR Letter 2024. An SR letter is guidance issued by the Fed to firms supervised and within our remit. This guidance is directed at large and complex domestic firms. SR 2024 is otherwise known as the Sound Practices Paper to strengthen operational resilience. You know, supervisors have a tendency to rely on scripted and concrete rules when we go in and examine firms. However, I would submit that a principle-based approach focused on objectives and outcomes, and not necessarily on specific conduct, is a more utilitarian approach. Under this approach, firms are responsible for finding the most efficient way to conduct their operations consistent with its own business planning and values, and of course in a lawful way. But what SR 2024 brings to the fore, the Sound Practices Paper, it's allowed us to promote a principles-based approach to operational resilience and operational resilience risk. These principles in 2024 are drawn from existing regulations, guidance, statements, and common industry standards. You see, as the pace of innovation and financial technology has accelerated, financial firms increasingly have outsourced their financial technology needs to third-party providers, creating potentially more risk. Therefore, the operational resilience of a firm can be limited by the operational resilience of its most significant providers. We need to work together to ensure that these providers attain the same level of maturity in their operational resilience that we expect from the firms that we regulate directly themselves. There is general agreement that operational resilience is an outcome of sound operational risk management. So the relevance of such principles for all the financial sector's participants, including third-party service providers, is apparent. we would simply need to explain how they might apply the context of a securities firm or an insurer or an asset manager, the same as the financial sector participant in the market. Connecting these dots and all these firms that operate in the sector will help ensure that considering both prevention and response strategies to operational disruptions are well placed. Similarly, having a clear understanding of the control framework will give confidence in assessing the effectiveness of response plans for scenario planning and testing. Likewise, scenario analysis for severe but plausible events will help inform a firm's risk appetite and its tolerance for disruption. Second, continued effort to develop common terminology in this body of work is a vital undertaking. A lack of a harmonized approach to develop common terminology would limit the extent to which operational resilience can be strengthened. Thus, to come to a common understanding how to best bolster a firm's operational resilience, we need to speak with a common language. And in fact, the FSB recognized this need in the cyber sphere when it issued its cyber lexicon. The FSB today is now actively engaged in work on third parties and has appropriately teed up a common terminology and definitions for that work as an immediate priority. A common vocabulary can serve as a strong defense against harmful regulatory fragmentation across sectors and jurisdictions. Third, while we embrace technological developments that provide cheaper, faster, and a more inclusive financial system, we must ensure that the benefits from digitalization of finance does not unduly expose greater risk. Our growing reliance on third-party based technology services, coupled with this increasingly systemic and complex interconnected financial ecosystem, is a trend that will continue to grow and magnify. New entrants, to be sure, will be incentivized to achieve at least the same level of operational resilience that the wide array of potential disruptions stemming from technological failures, such as cyber risks and other hazards, present to all of us. Fourth, the development of quantitative measures to assess the relative operational resilience of firms and the financial sector should be undertaken. Work in this area could entail identification of operational interconnectedness and interdependency, though such approaches require a deep network analysis. This could and should be used to better assess and evaluate systemic implications of potential operational disruptions, hopefully before they materialize. At a minimum, such analysis would inform assessments of concentration risks and, importantly, substitutability. Facilitating the identification of potential exposures would enrich the analysis of severe but plausible scenarios and enhance recovery mechanisms. Finally, both national authorities and firms under their purview need to focus on their people, as without the efforts of many individuals coming together with a common purpose here, operational resilience is simply just can't be achieved. Any authority or firm will say that its people are its most precious asset. We should not be satisfied with this as an empty platitude, but rather insist that we and the firms we oversee are actively engaged in ensuring that our people are well equipped, well trained, and well positioned to deliver on their mission. So let me summarize those steps once again that I just mentioned. We want to, one, use consistent standards and have consistent expectations across the financial sector. Two, the use of a common terminology has ultimate utility. 3, keeping our eyes open to both the benefits and risks of new technological developments from an operational perspective is important. 4, the development of quantitative measures to determine the operational resilience of individual firms and the financial system as a whole. And 5, keeping the focus on our people who play a pivotal role in all 4 of those things I just mentioned. So in conclusion, the speed of financial and technological innovation and the growing awareness of financial institutions' susceptibility to disruption from things like natural events like severe weather or even epidemics has brought operational resilience to the fore of our concerns. Resilience to cyber incidents, of course, is a high priority to us, but we also remain very mindful of the full range of operational risks the financial system faces. Many of these operational risks know no boundaries with respect to either sector or geography. The growing interconnectedness of financial firms means that a disruption to one can lead to a cascading disruption to a diverse set of firms across borders and can threaten financial stability. The case then for us to work globally across sectors to build up collaboratively the operational resilience of the financial system is very compelling. Fragmentary sectoral and jurisdictional efforts around making our institutions less, not more operationally resilient is an important undertaking. Strengthening the operational resilience of firms and the financial sector will require continued robust collaboration, cooperation, and partnership. Much still remains to be done, but I'm confident if we all stay focused, we can get it done. So thank you for allowing me to share some prepared remarks. And Nick, I guess we'll move over to questions.
Yeah, you bet, Tom. Nice job. I found myself taking some notes even. So, I've got several questions, and then hopefully the audience will have some too. But I guess given that this is a risk forum and you cover a lot of grounds and given your past experiences as well, how would you advise all of these professionals just to stay abreast of all these emerging risks? I mean, what would be your best advice in terms of just, even trying to keep up with everything you just talked about, and then obviously even more?
Yeah, so I mean, the operative word in that, Nick, is emerging risk, right? So that means that the evergreen nature of risks, continuing to pop up and change their dimension is really the challenge, right? It's not something static that we can point to. And, I said in my prepared remarks, us in the regulatory community, as we always fall back to our usual tools in terms of response mechanisms like capital and liquidity, but those probably aren't sufficient for some of the evolving and emerging risks they're part of it, but they're not going to be sufficient to, fully inoculate firms, for some of these emerging risks. So because they are emerging, I guess I would turn it back and say to, risk professionals and those who dabble in this space to, have a healthy and inquisitive mind, so a certain level of skepticism about everything, and just, a challenging attitude toward, how we're dealing with some of these risks. Forums like this can help, share experiences. And, I'm as I look and, as I talk about operational resilience and, some of the threats of cyber and such, we know that we in a regulatory community can't just force this on people and, insist that they get better. It's going to, I talked about public and private partnership, and I think, there's a lot of headroom there in terms of where, we can collectively challenge and confront some of the risks that are out there. So there's not one simple answer to your question. I would say just stay well informed, stay well connected and networked, and look for opportunities to share would be my short answer.
Those are good answers. And when I was commissioner, you'd have the people come in your office. You probably had the same thing. And I'd always say, I'm not worried about the risks I know about. I'm worried about the ones I don't know.
Exactly.
About. That's
Yep.
good. I want to talk about something a little bit off script here, off cryptocurrency. You didn't really touch on it, but it's in the news every day. Blockchain's in the news every day. You see some countries like El Salvador embracing it, other countries kind of banning it. I think the U.S. at the federal level seems to be taking a kind of a middle ground, wait and see, maybe an approach. How do you see this technology from the federal perspective, infiltrating, impacting financial services and insurance? I assume it's being talked about a lot, but how do you see this impacting our industry?
Yeah, I mean, it is being talked about a lot. I guess, I would start, at the Fed I would refer everyone to public comments of Chair Powell and at the time Vice Chair Quarles and others about crypto in terms of how it intersects with, what we do in the regulatory community. But I guess kind of a first order proposition is is it a solution looking for a problem? And the other part of it is, while crypto can forms a blockchain or a distributed ledger, not all blockchains or DLTs are cryptocurrency. So they all kind of need to be looked at individually. The idea of creating immutable records without the need for a central counterparty and enabling trust mechanism, I guess has some, but we are the producers of the U.S. dollars, so we have perhaps you want to look at this and study this a little more carefully before we dive in. I know there are firms out there who are financial firms that are testing and looking into it. Like everything else we do at the Fed, though, I think we're going to take a more measured and careful look at whether or not the distributed ledger and alternative currencies or a cryptocurrency rather has any utility. We are concerned, obviously, from a regulatory perspective. Make no mistake about it. I talked about ransomware and as it relates to the cyber threat, we have had and seen cases where, of course, crypto is being demanded as ransom. And in the case of the Colonial Pipeline, the FBI was actually able to claw back the ransomware crypto that was paid. So, I don't know. That's about all I have to say on crypto.
Yeah. No, exactly. I mean, talk about emerging technology at risk, right? We both served as insurance commissioners in two of the largest insurance states, at least. And, since you were commissioner all the way through my time, a lot of solvency regulation took place at the state level, obviously emerged out of the financial crisis. With the increasing complexity of these insurance companies and other financial institutions, I guess two-part question. How do you see the state regulation in the future? And then secondary, do you think state insurance regulation has done enough to keep up with this emerging complexity?
Yeah, and you and I both lived through the aftermath of I lived through and on the other side of the financial crisis. And I think it was a great test for the state-based system. I do think the NAIC and the states have upped their game in the last 10 to 15 years. I do believe in the state system. I do believe that state regulators have, continue to keep the insurance sector well protected. There hasn't been, the ultimate test of that is failures and insolvencies. And frankly, their record there is a pretty good record to run on. So I would say that should give us, but that gives us great comfort, but we shouldn't, sleep on that, right? So the state regulatory community would be wise to continually, and they do this through the NAIC and its meeting structure, continually test themselves, continue to look for new ways and new risks out there. And I would say, I've seen the evolution, I think you have too, of fortifying what's in their toolkit. When you think pre-crisis, where they were to where they are today, and how state regulators have, I think, pivoted away from the kind of myopic view of the legal entities and have really looked and interrogated more holistically to the top of the enterprise. And, with, examining ORSA and the own risk solvency assessment, a more probative view in terms of the corporate governance at the top of the organization, changes to their model holding company act, and on, Nick. All those tools and techniques, I think, have really fortified what state regulators are doing today versus if you were to look back 15 years from now, or 15 years previously, none of those things were being done. So the fact that they are evolving and continue to, strengthen and build out their tools is important. I would just say don't ever rest on that. Of course, like you said, we're always good at managing the risks we know. It's the ones that we don't know that, always challenge the regulatory community.
No, absolutely. So put your futuristic cap on, looking ahead. You talked a little bit of this, but what are the biggest issues facing these different lines of insurance? Because obviously on this webinar, we've got all lines of insurance covered when you look at sort of the list of who's in the attendance here. But what do you see as the biggest challenges facing our industry?
So yeah, I'll break it down sectorally, and then I'm gonna leave you with the one that's top of mind for me. So, within the insurance space, I would say I'll break it out: life, annuity, and P&C. I'll start first with life because it's kind of near and dear to our heart here at the Fed. We're in a period of prolonged. We used to say low for long. Now we say much lower for much longer. Appears to be kind of the operating. The modus operandi. So as long as that's present and there's no signs of, the rate environment changing, when you think about what does that mean for a life and annuity underwriter and how they face the market, we've seen, just in the last 3 to 5 years, product availability shrinking. The landscape of the players in the life and annuity space is changing. They're reaching for yield elsewhere. And this continues to put pressure on the business model. This has real world impact for consumers and buyers of product. Unlike Europe, the US does not have a state-run robust pension system. Our Social Security, some of the social safety nets, particularly Social Security and others are really challenged fiscally. So where is the middle American supposed to turn to for securing their retirement and their future? That's a real challenge confronting. I would argue it's a societal challenge. So I think the life and annuity space could play an important role. The question is, they are for-profit enterprises. How can they make a go of it under the backdrop that we're seeing today? It's a real concern. And I worry about from a downstream effect, what's going to be there from an availability perspective to the average consumer. So that's my biggest concern in the life space. The P&C space has a similar dimension to it. Just a day or two ago, I see where Chubb, one of the largest underwriters of, high value homes, has effectively announced they're leaving California. So, of affordability and availability due to wildfire risk of coverage continues to be, and they cited, like this or not, they cited the California regulatory environment around not allowing for a rate environment that reflects the risks of the wildfires. So, underwriters will vote with their feet. We saw this in Florida circa the mid 1990s in the aftermath of Hurricane Andrew, when the Florida property market all but dried up, and Florida state-run insurer, not the private market, but the state-run insurer, which was supposed to be the market of last resort, became the largest underwriter in the state. So, this is where the regulators play a very important role here. The underwriters will vote with their feet if they can't get rate. So on the other hand, I get the need for products to remain affordable and available, but the balancing all of those constituencies is a challenge for the regulators. I would just issue words of caution around, if you make it too restrictive, you'll have another Florida post Andrew if you're not careful.
For sure.
And then the thing that I can't resist leaving you with is something that I see more increasingly, and that's the threat of cyber intrusion. It isn't clear what the solution is. I would say that the insurance sector, though, does play a very vital role here. While I interact with international forums, and we see France and some other jurisdictions talking about or moving in the possibility of banning cyber insurance because they don't want ransomware paid. They don't want to perpetuate the threat of cyber by continuing to pay, which I appreciate that perspective, but I would just submit that insurance can play an important societal role. You and I both know, Nick, that before National Transportation Safety Board and others started mandating seatbelts, it was insurance companies that wanted seatbelts in cars. Before building codes and zoning restrictions required sprinkler systems in multifamily housing units, it was insurance companies that forced that discipline in property owners to put sprinkler systems in buildings. Like all those examples, I think here cyber underwriters and insurers can play an important and vital role in pushing discipline in firms on cyber hygiene and how to make them better, and how to make the firms think about what they're doing to fortify and build their own resilience. So I think prohibiting cyber insurance is a draconian, in my opinion, draconian approach, because you should look at what cyber underwriters could do to increase awareness and promote cyber hygiene and help as a solution, not as part of the problem, which I think some are looking at as part of the problem.
Yeah, no, that's a good point. A question, you might only be able to say what's publicly available. A question we got in the chat is, with inflation increasing quite a bit in recent years, possible impacts on marginalized folks the most, should the Federal Reserve reduce the purchasing of bonds? I'm not sure if you can say anything more than what's out in public.
Well, I'm not a monetary, as you know, I'm not a monetary affairs guy. We have the monetary affairs division. We have the super regulation division. I'm a super reg guy. So, I guess I'm not a macroeconomist, and I don't even play one on TV, Nick. But I have to defer to the great minds inside the Fed on that. I'm sorry.
Well, I don't have any more questions in chat, but one question I want to piggyback on the low interest rate. When you think about the life and annuity industry, and you talked about that low interest rate, we're seeing more and more complex consumer-facing products. I think it's fair to say as well. How do you think we should balance the complexity of product, the consumer needs there? I think there's some positivity in having some of those complex products out there for consumers to have better, retirement income, et cetera. But, kind of put your insurance commissioner hat on too. I'm just curious what you would say if you're in that seat about the complexity versus consumer demand.
So I'm a fan of, as you know, a fan of innovation, right? So one thing regulation can't do is stifle the innovation, right? So, but on the other hand, it has to obviously challenge, what goes into building the product. We've seen, we have had instances and seen cases where, maybe the regulatory gates weren't as challenging as they should be. That being said, you never want to stifle innovation. I just saw, I forget who the two participants were, so you'll have to forgive me here, but with the migration out of employer-based pensions and everybody moving to 401ks, what we've lost, of course, is the guarantee component of retirement income. Well, again, we we are the land of the free, right? And innovation is a big part of what makes us a great country. I see where some financial firms have partnered with asset managers who are custodians to 401ks and offering a guarantee inside a 401k. So it's almost a pension-like product, and I think there's a screaming need in the market for products like that, Nick. And, when we see these partnerships between firms like that, I think that's a great thing for consumers. So, because I do think there's an overwhelming need for those kind of products out there.
Yeah, no, I agree. We do have another question. So, and the question is, are there threats to the state-based regulatory system that would start to erode the system and trend towards a larger role for the federal government?
I don't see it. I mean, it could. If anything's possible, but that would take, as you know, it would take an act of Congress. And I don't know if anybody's studying anything I'm not in Washington today, but I don't know if you've studied Washington lately, but they seem to be a little preoccupied today. And they, of late, over the more contemporary period, over the last few years, seem to be challenged with their efficiency. So something like this, something big like this, removing authority, which today is a congressional act through McCarran-Ferguson, dating back to the 1940s, and vesting more authority in the federal government would require an act of Congress. So we have limited authority at the Fed by virtue of what came to us in the Dodd-Frank Act to supervise a small number of insurers who happen to own a bank. The reason why we supervise them is if they own a bank. But I do not see in the near term any movement to increase the federal government's role in regulating insurance. We're going to we are, obviously the guardians of the macroeconomy. So we will continue to look at insurance and how it intersects into the market. But as far as supervising individual insurers, we're content and very pleased with the developments the state has made. So, if somebody from Congress were to ask me, I have no desire to get into that space if it's being well managed and contained.
So kind of a follow-up questions come in along the innovation line. So if products become too complex, how do regulators balance the need for the innovation with the need to ensure that a policyholder understands what they have purchased?
Yeah. I do think that, and this is particularly, you shouldn't buy it, buying an annuity and getting a 150-page contract. I know it's a contract. Is problematic on its face, right? I mean, and I understand the necessity of some of those 150 pages, but it shouldn't be that, right? It shouldn't be that. And we're part of the regulatory community is part of the problem, not part of the solution here, right? So we definitely need to get better at that collectively, and this is where private-public partnerships need to get better. The one thing the NAIC has introduced over the recent years is with their consumer advocacy groups that are continued participants to the NAIC's forum, they've pushed the organization to get better here in terms of, the clarity of the contracts, the length of the contract, tightening some of it up. I get we live in a litigious society, so we have to accept that, right? So I understand why some of those are complex, but it doesn't really need to be that complex. I prefer a postcard to file my taxes, but that's just not the world we live in, right, Nick? So I mean, I would champion and get behind the premise of the question, which we do need to get rid of some of the complexity in products.
No, I agree.
And still promote the innovation. When you were a regulator, Nick, I used to say, if you can't explain it to grandma at the kitchen table in a pretty succinct fashion, then you ought not to be selling it, right? I mean, it can't at a consumer level. That doesn't mean that in other places products don't have some utility, but at a consumer level, it needs to really pass that kind of a smell test.
No, I agree. You know, I think when I look at a question like that and put my former hat on as, you know, Commissioner in Iowa, you know, you think about the complexity of some of these index products. And while there is
Yeah.
some utility for the consumer, you know, trying to explain it to grandma or even me, it can be very difficult.
Yeah.
Another question has come in related to cyber. As cyber insurance becomes more difficult to obtain and more expensive, because I've heard from a lot of people that renewals this time of year actually get pretty expensive for a lot of businesses. Do you see the federal government offer cyber insurance to companies at some point, sort of like a TRIA program or, you know, flood program? I mean, that's an interesting question, right? I mean, because it almost is, in
Yeah,
my
I'm
mind,
not-
becoming an uninsurable risk.
So before we get to that question, you have to think about where is the insurance sector in where is it historically? And I'll tell you where it is historically, you know, especially most of the P&C and specialty underwriters who write that risk. We're talking about capital surplus levels that are at historic highs. So capacity, as you know, Nick, capacity to underwrite is not the problem, right? They're looking to deploy their capital and get a return on taking risk, right? But, and here's the but. The but is they're not going to just throw it away. They're not going to throw it away, right? So they need to understand the risk. When the underwriters don't understand the risk, they become a little more guarded and back up. And you know, this falls into the category of emerging risk that we talked about with your first question. So, you know, as it emerges and as underwriters get, you know, gain a little bit more of an understanding and can, you know, either satisfy themselves, you know, when we look at cyber intrusions, Nick, this is probably not going to surprise you, but most cyber intrusions are preventable, right? It's silly things like, you know, end of life software, you know, where it's, you know, outdated software and, you know, other techniques are not being, you know, it's kind of simple stuff, you know, two-factor authentication and, you know, things that are pretty widespread out there. The perpetrators are looking for the easy way in. So here again, the underwriter I think can be helpful in terms of helping the private sector. Now, your questions, you know, the question centers around, you know, the which we've seen in cyber premiums that reflects, you know, kind of the warp speed at which this risk is emanating. I would think, just given what I said at the start, which is there is capacity to underwrite. As long as the insurers can gain comfort around what they're writing and or put some limitations around the risk, I think you'll find that the market will accommodate. I don't think, the second part of your question, government solutions in the private sector where, you know, the business of insurance is largely a private contractual exchange. You know, very few times has the federal government, when they've stood in the place of being an insurer, have they been successful. You mentioned the National Flood Insurance Program. I would submit to you that that's an abject failure, right? So,
I would agree.
so, you know, there's chapter and verse of when the federal government has tried to become a private institution and it's failed, and insurance in particular. So I'm not a big fan of it. Doesn't mean I would rule it out, but I'm just not a big fan
Well,
of it.
let me ask you a piggyback, and I agree. The flood program is a disaster. TRIA seems to be where there's a limit, almost like, hey, I mean, that kind of a thing I could see evolving. I mean, that would
Yes.
be more sense. What do you think?
I do. Yeah, that's actually a good example. So
Yeah. Where basically the industry picks up the first amount and then it goes to sort of the insurer of last resort.
it's a backstop mechanism.
Yeah. So another good question has come in, and we have some InsurTech founders throughout this program too. So this is an interesting question. What precautions can carriers take as they partner with InsurTechs and other third-party firms to prevent regulatory issues? Are regulators looking to make changes to become more accommodating or more restricting of the new technologies with these third parties and what they bring to the equation?
So, you know, third-party risk was a big part of my prepared remarks, Nick.
Yeah.
It's evolving and it's ever changing, but we can't ignore it, right? So, a big part of the equation is making sure the firm itself, the insurer or the bank, has a good handle on the institutions it contracts with and ensuring it's satisfying itself that everything it's doing from a good housekeeping perspective inside the bank, insurer, or financial institution, they're expecting the same level of attention at the technology firm, and perhaps even more. So where does the regulator come in? So, you know, in the banking space, we have something called the Bank Services Company Act, where at the Fed, I don't know if you're aware of this or not, but we can examine and subject the third parties to the very same level of if you will, examination that we do the bank itself. So, that's pretty broad authority, and that's pretty significant authority. But it gets back to the thing I mentioned earlier, which is, we don't want to stifle innovation. That's not our intent. But we do want to see good hygiene, best practices, following the principles I talked about in SR 2024. That is something that we would suggest third parties need to embrace just as much as the institution. So not stifling innovation, but still making sure that the third parties are themselves as resilient as the firms themselves.
No, I agree. That's good stuff. And I don't know much about that act, but I do take a number to pull that up because it is an interesting tool in your toolbox at the federal level for sure. Right? I think those are all the questions that have come in. I guess, Tom.
Perfect timing, because the lawnmower just started, Nick.
Well, hey, Tom, I just want to say thank you. I know you're incredibly busy. Having someone with your background, kick off this was just, amazing. And it's good to see you. Hopefully I'll see you in person sometime here in the next, few months, but hope the family's doing well. And again, the committee, we just thank you so much for taking time out of your schedule to kick us off.
I appreciate it. And thank you to you and Drake for having me this morning. I appreciate the time to spend with you. And likewise, it'll be great when we can get together and have a beer and catch up on old times, Nick. So, and thank you to everyone out there for attending. Yep. Bye-bye.
See you around.
Nick and Tom, thank you very much for an engaging session relating around really the risks financial institutions are exposed to, and the regulatory environment and the regulators that oversee us. Thank you all. Our next session will be on break. Our next session will start at 9:15. So in about 15 minutes, we'll get the next session going, and that will be a reflection upon what we've learned in the pandemic and what can we do about it going forward, and how that'll influence business decision making going forward. So just hang with us, take a short break, and we'll be back shortly. Thank you.